Alrighty, welcome. It is Friday, March 29th, 2024. Good Friday. Markets are closed today, but didn't want everybody to just go through withdrawals of not being able to talk about trading or stocks today. So let's, or markets or anything else that you want. So I'll open it up for you guys as well. I'm going to touch base a little bit on the FB and BA112 trades. We'll talk about those today a little bit more. I'm going to actually pull up my trade plan as well. We'll go through those and just what the difference is in between the two of them from my standpoint, as well as how to set them up and how to really, I'm not adjusting them, but how I may tweak them depending on what the market's giving me a bit. So if you have questions on those specifically, let me know on that. Let's see. All right. So yeah, post in chat. I'm just checking chat out here. So if you have questions, we can try to get to that. So let's jump in and let's just jump into, first I'll go through the trade plan part of things here. Let me move that down. If you're looking for any of the BA112 stuff, that's all the way at the bottom when you get into past spec trades and we get into hedges. So I'll talk about that. Not that these are really true hedges, but I do use them a bit in a hedging style format. My hedges are really these long puts on ES. That currently is the way I'm hedging my portfolio. That along with diversifying my strategies. My 112 trades are down to less than 50% of my buying power. I do take the naked puts off. I leave either the put debit spreads or I remove the shorts of the put debit spreads. So my style of hedging is just to leave either a put debit spread working or just a long put of a put debit spread working. And then I also buy puts religiously each month. And I do it at the beginning of every month. So just to stay consistent, I'm putting them on at the beginning of each month. I did have an extra hedge on that just came off, but I do have an April 5th hedge that'll end, but I'll probably on Monday, I'll probably start a new hedge. Anyway, they are an expense to me. They will chew up about 6% of my entire account every year to hedge. I haven't really found a better way to do that at this point in time. Lots of hedges out there. We aren't going to make today all about hedging, but I find that this is at least gives me some relief. But even in a sell-off, if you have something that's too far down, it's not going to give you a ton of relief unless you have a massive black swan type event. But my biggest concerns always for me are really 8 to 12%. 5 to 10% is probably not even 8 to 12 is even too much. Probably a 5 to 10% pullback downtrend, something like that in a given time. Doesn't mean you can't go down 30% in a year, but in order to go down 30% in a year, I have to be going down 3%, 4% a month. Over the span of 2 or 3 months, you're talking 5 to 10%. If that's the case, and that's what I'm looking to hedge, number one here. But then that dovetails into the BA and FB trades and what they will help me hedge as well. So the BA trade, which is the big ass 112, and the reason for the BA nomenclature there is that this is a long kind of wide, still narrow, 50 points wide. So it's only a 50 wide hedge, but it is long with the naked puts very, very, very far out of the money on the BA trade. So this is a good trade that if we're moving down 5, 10, 15, 20%, maybe even 30% in the market over the course of a couple months or so, really 30 to 60 days. If that, in fact, does happen, this trade will do pretty nicely. Now, if we go down 30% overnight, this is not meant to be a black swan hedge because the naked puts on this will most likely blow up if we go down like 20% overnight or something. But if it's simply just a 3, 5% a month for a month or two, downtrend, which is what's mostly typical, and that'll happen about every 12 to 24 months. You will get a pullback of anywhere from 5 to 10%. So that's, to me, the one thing that's most important to me is trying to protect myself when things go down a bit, according to just normal market shifts. Okay, so the BA trade, we will go through it, but it is a 50 wide put debit spread, and it's put on for almost no credit at all, maybe a small credit of maybe $1, something like that. I'll still manage to put separately. I'll still potentially maybe close those naked puts. Now, one of the things that you'll see here on the naked puts, if the naked puts are about 50% of the initial credit or so, or 50 cents, you can close them. It's a little different than the 95%, but the reason for that is these are very, very low cost puts. So I'm fine getting out of them a little earlier, because the goal here really is the trap. Trap management's pretty much the same. And if you're in the trade plan at all, you can take a look at what that looks like. We're going to model one up anyway here, but you can see if you can make it out on this. Okay. So you can see, let me stop sharing as well. Okay. I turned off video, and then if you guys hit the little minus button, you can make it smaller there, so you don't have to see all of the other little black pieces there. So you can see how long this trade is. I mean, with this example one, I don't know what the market was at the time I put this on, but you can see that the beginning of this trap starts at 4,100, and it goes down over 1,000 points to the bottom. You can see I put this on for a $4 roughly naked put in here. So if this thing gets to like $2 or so, maybe $3 of, I'm sorry, $3 in profit. So maybe $2 in value, maybe $1 in value. I could potentially take it off depending on what I'm seeing in the market. If the market's going up like it is now, just let the thing cook a bit. If we start to heat up, maybe you pull it off. But you can see too, this orange T+0 line, very flat all the way down to about 3,500 or so. Then it starts to steepen a bit as it goes down here. So that's the BA trade. It's just a big, long trap. Right? And that's good for a nice slow market move down of significant length. Okay. The FB trade, and whether you like either one of these names, the FB trade, the reason I named it that was that this is a big fat trade. Okay? It's not a wide trade like this. It's a big fat trade. Essentially, I'm looking for at least 100 wide put debit spread and maybe more. Typically for me, I'm usually getting 110, 120 points wide for most of these. And again, I do these about 60 days, but this is being used more for a big, not the 20% downturn, but maybe a 5 to 10, 15% downturn here, but no more than that, because I'm not moving these naked puts down too far. I might take these off maybe 50% or maybe 50 cents or something like that, depending on what they are. But you can see here the difference. I don't know that you can see this well, so we'll model it, but you can see that a 50 wide on ES, okay, knowing that this is ES is a 50 multiplier, a 50 wide on ES is $2,500 in the trap. Okay, right? So 50 wide times a 50 multiplier, $2,500 in the trap. Now on these, you can see that the trap is much shorter. Remember, the last one went all the way down to almost 3,000. This is only going down to about maybe 3,500 or so on this particular one. Again, I'm putting these on for almost no money. So I know this is blown up, so it's a little bit different. Okay, 100 wide, put debit spread there. And then I'm also going to do 2 naked puts that are somewhere around that 5 delta or so. But I'm, again, very small credit, if any, here. If you even want to do a small debit, you could. But at 5%, or I'm sorry, at 5 delta, you're only going to get down to about 3,400 on this particular trade when we were sitting around 4,300. But you can see that if we hit this trap, this is now, this one is actually 125 wide times a 50 multiplier. So you're talking over $6,000 in the trap. Okay. That's the two different ones in here as I talk about the different reasons for these as well. We'll get back to the normal, and then also some put butterflies might be hey, I think the market's going down significantly next week. I might put a butterfly on. It's not the same as it's a hedge, but it's really more of a bearish trade. So let's jump into the portfolio, and we'll take a look at what's going on in the portfolio here. And we want to put these on an ES. And again, I don't know how ES will look today, a day when the market's closed. You never really know. But we're going to go out to May 31st, which is 63 days in trade. Now, understanding that I watch the markets. I'm trying to get a sense of when these would be just the right time to start to put these on. And even though in my positions right now, I have, so I'm sitting on a 63-day hedge that expires in 7 days. I've got a 112. I've got some naked calls, okay, which are pretty much just flat. I've got this BA Frankenstein type of trade, which is not doing much of anything. It's down $140. I've got these put debit spreads, and I have another piece of the 60-day hedge there. That's 30 days in right now, and then a couple full 112s that I'm riding here. But I do have a BA112 here, and I did not take this off. It's under 21 days. Most likely I will take it off probably on Monday. I just haven't done it. It's well past, like I said, either 50 cents or 50%. It's not at 50 cents yet. So I'm letting it go to maybe closer to 95 to 50 cents, and then I'll take this off. Right now, the market's not really showing me any reason to drop, so this trade's going to probably just expire. Now, I did put this one on for a little bit more, $11 as opposed to typically $1. So a little bit more income. So it's a little bit of an income trade as well as a BA trade. So let's get in and take a look. So you can really size these as to what matters most for you. And we can talk about a little bit of the Frankie style trade. I do it a little differently than Rob, and I give Rob all the credit in the world for that trade. So you can check out how he does it. I might do it a little bit differently or a little setup, but for the most part, it's the same style trade. And what the Frankenstein trade does, it's about the same as an FB type of a trade, in my opinion, or the BA, except that you're adding an extra put or two or so long put at the top. All right, so let's just create this the way that we would, and we'll start with the normal BA trade, and then we'll take a look. If right now, understanding that the markets are overbought weekly, and the weekly chart to me is the most important chart. Okay? Daily charts really don't mean a whole lot for my style of trading. If I'm trading 60 DTE 112s, 90 DTE strangles, 120 DTE either naked puts or 112s, and potentially leaps, there's no real reason to be looking at a daily chart. So when I post most of my charts, I give you a sense of what the weekly and the daily are doing. But to me, it's the weekly that makes the most sense to me, because that's what's really going to affect me over the long term. What the market does for the next 3 or 4 days, or 5 days, or 6 days, or 10 days, or 20 days really has no effect on a 120-day trade or a leap trade. So I'm not really trying to hit the bottom. Now, I'm going to campaign trade most of the 112, so it doesn't really matter. But I'm looking at the weekly chart. The weekly chart's overbought. And you know what? Let's just take a quick look. Okay. Here's the weekly charts. So weekly on this side, dailies on the right side. Taking a look at this weekly chart here, MACD has been very, very flat overall. Okay. But the RSI, you can see it's been overbought, but rising. And you're over the 3 ATR, which is this white line, and rising. But as long as this 3 ATR is moving up, you can ride this until it starts to tip. And it's now starting to maybe tip over or flatten out. We'll see. That could all change Monday when we maybe break through this high and we launch another leg higher. We'll see. But it is overbought. And you can see the squeeze momentum here has been coming off for 4 straight weeks. To me, that's a good precursor. We're still going up, but momentum is coming out, which means, and we're overbought. We can stay overbought, but I think the odds now of some sort of a pullback are better than they were. They're better than they were when you had this squeeze firing and you were just moving up every single day. Okay. Now that squeeze is starting to dip a bit, MACD is starting to dip a bit, but you can see the MACD lines here are still pointing solidly up, so, and as well as RSI. So right now the momentum is up, and this is like a train. The train is at pretty high speed moving. In order for that train to slow down and then go in reverse, it's going to take a long time to slow down a freight train that's at high speed until it comes to a stop, and then you have to put it into reverse, and then you have to pick up speed going in reverse. Hope that makes sense to you. So market timing's not a good, not the best thing, but it gives you some sense of the train might be starting to slow down, even though it doesn't look like it a whole lot. I'm trying to make a decision here as to what's the best trade. I've got some hedges on. I'm fine with that. I'm more worried about a 5% pullback. And a 5% pullback from here would be about 250 points, 300 points maybe, which puts us down to about 5,000, which would put us probably where this 21 EMA is going to be on the weekly. That would also put us somewhere around where the 50 EMA is here on the daily. So, and that's also where the 3 ATR is on the daily. To me, that would be the target of a pullback. Another pullback target here on this particular move would be either the 50 or 61, okay, or 618 retracement. So the 50% retracement of this move, 4,700, the 618 is about 4,600. That would be, to me, the extreme levels that if we break through a couple of these zones in here, that's what I would be targeting. If the 21 doesn't hold and the 50 here, which would be the first target, doesn't really hold, then that's what I would be targeting. And for those that I don't really look at the 38 fib, but if I added that onto it too, that'd be around 4,900, 4862, somewhere in here. I don't really use that fib much of anything. So anyway, I want to get a sense of where would the markets go if they pulled back. So if you're thinking a 10% move, 10% move would be a little over 500. That puts us around 5,000. Okay, if we keep moving up. So it would be 530 points from here. I'm sorry. We're at 5,300. Okay, and a 10% move is going to put us around 4,770. Just making sure I got it. So somewhere around 4,800 would be that move. So 530 points to the downside. So where would that, where's that going to put you? Which one do you think would be better than if we start to pull down somewhere to this 5,000 level? Maybe if we go to 4,700 or more, that would be a bigger move to the downside. And now you're talking on the fibs, what did I say, 4,700 or so? 4,700 from 5,300. about 600 points, okay, which is about 11, 12% or so to hit those fibs. So the first one here to me is a decent pullback would be an FB type of trade for me, okay? Because it's a sharper, shallower pullback of decent size, probably pulling back 3 to 5%, maybe let's say 5%, 250 points on a 5%, 300 points, pull back to about 5,000, right? And again, I'm going through this maybe painstakingly with you, and you're thinking, speed this up, Tom. But I want to get a sense of which one would I use and why. Okay, the BA would be, we start the downtrend and we see the downtrend beginning and it starts to accelerate. A true pullback would be a 10% pullback to one of those fibs that I mentioned. I'm sorry, I took them off even. Okay, to the 618. Okay, 4,500, 4,700, somewhere in there. That would be a perfect reason to use a BA trade. Okay, because we have a longer downside. Okay, and it probably will take a little while to get there, kind of like this pullback did here, where we started this pullback in August, and it ran all the way to its low at the end of October. Okay, so you have August, September, October, 3 full months for this pullback, and then we went higher. I'm expecting that if we get a good pullback here to a fib level of maybe 4,700, and what did I say 4,700 was from where we are now? Okay, that's 600 points. Okay, that is a roughly 11% move, right? So an 11% move to 12% move to the first fib level. If we go down even further, okay, that was the 50% fib. If you go down to the second one here, which is maybe the 45.80, so 45.80 from the current 53.22, 742 points off of 53.22 is about 14% to hit the 618. Okay, why am I going through this whole thing? Is I'm trying to get a sense of which trade would make the most sense depending on what you think is going to happen. I think at some point, a 50% pullback or even a 618 would not be out of the realm of possibility on this pretty sharp move here, depending on what happens in the markets. I think initially, though, coming down to 5,000 here, where the 21-day moving average on the weekly, and that's also where the 50-day moving 50 EMA on the daily is, somewhere around 5,000 or so. That's 322 points from here off of 53.22. So you're talking a 6% pullback, okay, being more of like an FB style trade. That would be the first trade would be an FB. And if we really start to think that this could keep going, then a BA would also be mixed in. All right, so there's kind of the reason between the two. What do you expect to happen? And to me, the first line of defense is probably an FB trade, then a BA trade if I'm overbought here and I start to tip over to protect myself, give myself a little bit more money going further. Now, both of these do require naked puts to power the engine, which means you're still going to potentially get some pressure on the naked puts depending on the speed of this move and IV. If the market starts to reverse, Dave, typically when the market's already in a pretty good downtrend, it's probably too late. But I'm looking at, are we running out of steam? And I'm waiting for something to start to curl down on the weekly. Okay. I'm okay not being first, okay, but I'm okay being just after that for some of these trades. And I believe when we're sitting at the top and you have buying power, then I think it's okay to start with an FB trade. And then weekly BAs in a sustained downturn, Brian. I don't know if that's I don't know if that's absolutely critical to do it that way, but I think you could. But if you're already in a sustained downturn, to me, the FB trade might be a better trade. It's going to pay off more in a sustained downturn. The BA is good. It's safer. It's going to give you more runway to the downside. So if you expect a longer protracted move, then I think the BA is the better trade. All right, so let's jump back into the platform. So I'm just giving you a sense of where you would use both. It's really, I don't know that I can mechanically tell you that, hey, if this happens, put an FB. If this happens, put a BA. Just understand that the BA is for more of a 12 to 14% protracted downturn. Okay, that's going to pay decently. And then the FB trade is for more of a shorter, but pretty decent 5 to 6% pullback, which is usually first. Obviously, right? We're going to get 6% before we get down 12%. So what you want to do is maybe start to protect on both. So let's start with a BA trade here, just to map it out. BA trades typically going to have some of the same setup characteristics that you may have in a standard 112, right? So I'm using ES here to do this. I'm going to go out about 60 days, which I have. Okay, I'm going to put a 50 wide spread in, which I have right now, starting at the 25 delta or so. So that's the first piece of it. And then I'm going to finance with 2 naked puts that takes me to almost 0 credit. Right, so this is costing me $8.65. So I got to go down, find something that's at maybe $4 and change. And these numbers are kind of funky today, but this would essentially be it. Okay. And I don't even know if we can fit the whole thing on the screen, but we'll certainly try. Yeah, we can. All right, so here it is. All right, you can see very small credit, $1.75. So if we're in the tail, okay, I make 88 bucks, no big deal. I don't even care if I make $88. Maybe you keep going until you can get this thing to almost exactly 0. Okay. So there's one way of putting this on. If you don't feel that this pullback is necessarily imminent, this is probably the way to set this up. Okay. And typically buying power on this is going to be around 4 grand. You can see my buying power is just all funky anyway. All right, but this is really the typical BA trade. This is a really long ways down. So you're starting at about 51.25 all the way to 42.50. You're almost $1,000 in this, $1,000 drop in this trap. 42.50, by the way, from where we are today, which is 53.04, okay, is 1,054 points. Okay, so this is a 20% downtrend. Okay, so we're good for 20% of slow downtrend. Okay, if we go 20% tonight, it's going to be in pain. So it is what it is. That's not the purpose of this thing. Okay, but if we go down here, you're going to lose, 13,000 on this trade. Where right now, a 2x loss is going to occur somewhere in this neighborhood here. So somewhere around 4,700 is where we'll start to get to that, maybe a stop loss area if we moved quickly. If we move slowly, okay, this line's going to lift and we can go even further down. So it gives us a good cushion, right? So yeah, just, CW, yeah, covering commissions is fine. I don't even care. The commissions aren't a lot on it anyway. There's not a lot of moving parts here. So this is one way to do this. Okay. The other way to do this potentially would be to shift some of these strikes up a bit. All right, so let's take a little look back at the table here, and let's grab these. And now instead of 25, you could look to potentially move this up a little bit more, maybe 5,200. okay, which is what I had done here already. All right, so now you can see that the mouth of the trap is much closer to our strike. I probably like this setup a little bit better. I'm still down here around 44.75, and in reality, okay, that is a 3 delta naked, 2 naked puts at 3 delta. You could probably even go, one more if you wanted to. Right, so this is just giving me a slight credit. I mean, $30 here. No big deal, but I like moving the mouth of it up here a little bit more. I have a higher chance that even as this market keeps going up a bit, I'm still not as far away. So I would give up a little bit down here. This is still a pretty good drop. You're still talking of a 900-point drop to get to here. 850, 900 points to get down here. That's still a pretty good drop. If we get down here quickly, we got bigger problems anyway. So this is a BA trade, thin, long, slow, down grinding piece. Doesn't pay a ton, okay, but it doesn't cost a lot. And if you get into the trap anywhere in here, you can probably start to close these traps off at some point a little bit earlier. All right, so that makes sense. You can even shift it up, maybe even a little bit more. Maybe we can shift it up even more. Okay, so here's it shifted up even more up here. You're at like 52.30, 51.80, something like that. You're really close. Could you shift it up more? Yeah. Now you got this is a slight debit here, but it's doggone close. 4,600 though is not that far off. So 4,600 from the 5,300 that we're at now is 700 points. Okay, which is roughly still a 13% downtrend. So the market still has to drop 13% for these naked puts to really be a problem. And I put this trap right up to it. Probably a little bit too much for me. I'll stick down a little ways down here, but I think you guys get the point that you can go a little bit higher, maybe something closer to 35 to 37. I think 40 is too high, 40 delta. But I think these will give you a good BA trade. All right, so there's the BA trade. Okay. Long, slow, grinding down, 20%, 18% move. This is 13% for this one. Okay, well, actually, this is a little bit more. This is like $800 on 5,300. Okay, so this is 15%. Okay, so 1, 2, 3, blah, 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 blah. All right, so that's when this is going to be beneficial. So are you at a top now? I want to start putting on more of these particular trades. All right, so the next thing is, how can we make this a fatter trap? Okay, something that's more along the lines of a 100-point wide trap. Okay, we might have to move it down just fractionally here. And again, for the FB trade, I'm doing something similar. Okay, I want to get a sense of where we are here. Okay, I might start at that 25 delta. I might be 100 wide on this, and then down here, I'm going to monkey with whatever the bottom here is until I can get to essentially 0. Okay, so that's what this did, and we'll fix it. Okay, so you can see what this thing looks like now. So on the FB trade, you can, now that we're 100 wide, you're now a $5,000 in the trap play. I don't look at volume or open interest when choosing strikes at all. Okay, all I'm looking at is I'm starting both of them around the 25 delta for the long. Okay, and then I will technically just go here. I'll just start playing with it to see what makes the most sense for me. That's where I start the trade. So this is where I would have started this FB trade. And like I just did with the BA trade, this now has to, before it gets into the trap, it has to fall almost 200 points from here. Okay, so a 200-point drop on 5304 is roughly 4%. So even a 4% drop, okay, let's move some time off of this thing. I'm not even going to do that. You know what? Let's just look. A 4% drop. It's not even worth it. A 4% drop here. This might start to lift depending on my time frame. You can see how it lifts to begin with in here. But as time goes, this will start to lift early. So you might not need the full 3 or 4%. But for me right now, this takes 4% just to get into the trap. Okay? But if we do, okay, we're going to pay off. But look at the steepness of this curve as well. So you're not, super far away down here with this, but it's giving me a big fat trap. So I do like the FB trade here, and I might even consider moving this thing up a bit. Now, when I move it up, you're also, in order to not spend a lot, and a little debit's okay. Okay, 4670 is the bottom of this thing right now. Okay, so 4670 from 5304 is about 634 points, which essentially is 12%. Okay, so if I'm expecting a 5% pullback or so, this trade makes the most sense. It's going to pay off really, really well. But I have a much higher naked put here. And my stops for the naked puts are still 2x. Okay. So I'm still looking at either a 2x or the trap or whatever you want to use here. But I think a 2x on the naked puts is what I would stop the naked puts out at. Right? But 5%, it's a good little trade. If it starts to go down a couple percent, couple more percent, this thing really starts to lift over time. And then over time, okay, that T plus 0 line is lifting a bit as well. Then the volatility changes. What is this? May 31st. Okay. And if volatility starts to either run up, depending on which puts I'm looking at, okay, it can also lift that line as well. So volatility starts to crank up, this thing will do pretty well as well. As long as you're probably in that 5 to maybe 10% range. Outside of 5 to 10%, okay, this thing starts to get tested too much to the downside. Right. So to me, a slow and steady, decent pullback. The BA is I'm a little bit more comfortable with that trade because I don't have as much at risk with these naked puts if we start to move hard. Now, if the market's already moving down, then an FB trade might actually be a good trade because you get some more volatility. I can get a little bit farther away. So the BA actually might be where I might start because it can move 20% against me. I'm going to maybe go back to the beginning here on the BA. The BA is probably the trade that I would look at first because it's safest. And if we are going to have a long protracted downtrend, it's going to be in good shape. The FB trade might be something that's a little bit more valuable when we're already in somewhat of a downtrend, excuse me, and I get more volatility. I can get these naked puts a little bit farther away, and we're already moving lower into that trap. So it's going to kind of pay off on the trend. But if it's too early in the process and you get a 10% pullback, an FB trade is going to get tested more. Does that make sense? Trying to keep my voice from completely falling apart. So BA would be early in a sell-off from a extremely overbought level where we are now. The BA is where I'll start. The FB is really where I'll move to once that's sell-off begins. All right. So yes, 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 Jill. So BA first. Yeah, that's pretty much what I would be looking at, depending on the market and what you're doing with it. Now, the other ones I like too is I love these BA trades in the NASDAQ. Okay. I think the NASDAQ is a little bit more susceptible to some downtrends right now. So these set up really nice here. I mean, I can get all the way on NASDAQ. Which trades which? I can't even get it on the screen here, but you'll get the point. Okay. This is so long I can't even fit it on the screen. All right, but here's the NASDAQ one that I have working on. I believe this is the May 31st one. Yeah. All right, so this is the May 31st one that I have working. Checking. Yep. All right, so this thing pays off really nicely. You know, $4,000 in the trap. We're not that far from the current price. Okay, so I've moved it up, but way, 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 way down here, okay, is where we'd have to drop to 15,640, okay, from 18,465. So the NASDAQ has to drop 2,825 points, okay, and that is a 15% down move. So this, I just put one of these on the other day. We had one that was nice, doing nicely, and then it pulled out of it, and we ended up just breaking even because we didn't make any money. So that one just closed the other day. But I did put another one of these back on. That now that I see the NASDAQ, that one to me seems like it's tipping over a little bit more. All right, so on the weekly chart, you still have like 4 good bars to the downside. You're not overbought on RSI, but it's already starting to head lower. MACD is heading lower, and the weekly, the MACD is heading lower, the squeeze is heading lower. So, and you've got a bearish PSAR signal right now on the NASDAQ. So I like the NASDAQ one here. Is it okay to go with a 113 to go further? And I wouldn't. But that's just me. To me, a 113 scares the living pants off of me. And I will tell you why. When you model your portfolio for a downtrend, the more strikes you have that are lower, I don't care how far out of the money they are, the more you have in an IV expansion of any magnitude, those are going to really crank up. 3 farther out of the money puts is way worse than 2 higher delta puts, which is worse than 1 higher delta put as well. Okay? Depending on what you're trying to hedge and what you're trying to do. The reason that my trade plan has been modified a bit is in the small group class that we did a whole week on hedging. And what we found when we did an experiment was when I looked at spending, let's say, a certain amount of money. So we're sitting at $470,000 account here, and I want to spend 0.5%. Okay, that's like $2,300. When I'm spending $2,300 on a hedge, my hedges are 60-day. Okay, you can do your hedges a couple different ways. Okay, so a couple different ways to hedge, and this is just why I do it. I'm not saying I'm right. Anybody can have an opinion on hedging, but when you look at what is the difference in cost, so I want to spend, let's say, $2,500. So I want to spend $2,500. I could go here and buy. I'm so used to selling, I can't even buy stuff. Okay. All right, so here I'm going to buy 2 puts here. These 2 puts will cost me $2,550. Okay. Or I can go down, instead of buying 2 puts, I could buy 4 puts down here at maybe, I'm going to delete these. I could buy 4 puts at maybe $11. I can only sell. I can have trouble even buying something. Okay, I could buy 4 puts around, the 6 delta, $12. Okay, so $12 here. These 4 puts here in a severe downtrend with significant IV expansion will give you more gains than 2 puts up here. Okay. Also, all depends on what you're hedging. Okay. But if you're hedging for both a decent IV expansion and a sell-off, 4 puts here is better than 2 puts here. Yep, didn't mean to do that. Okay. So these 2 puts, these 2 down here, and then if I went even further and took this to the next level and went down somewhere around $6, okay, and I bought 8 of these, okay, for this, okay, I'm going to get rid of the other 2. If you get the point by now. 8 of these still cost me the same amount of money, but 8 of these puts pays me more than on a significant downtrend in an IV expansion. These 8 will pay me more. So, but you've got to really head down for these to start to kick in. Now you're 1,000 points down, and if you don't go down more than 300 or 400 points, these aren't going to do squat. But this is where, maybe from a black swan hedge standpoint, you guys are sitting on a bunch of these low puts. If the market goes bananas, it has to have a massive IV spike, number 1, and number 2, you have to have a massive 1,000-point drop or more for these to do anything. Otherwise, they're not going to help you in a 5 or 10-point sell-off. So I'm looking to split the difference a bit on this. So I just want to give you why I think that if you mash these all up, it gives you a little bit better positioning for not only just hedges, but for your BA trades or something like that that you're going to put on. So I don't want to have something that has a 113 in it. So getting back to the 113, because the 113, depending on which trade you're doing, you've now added 3 more short puts that in an IV expansion are going to be more painful than any of the money you could possibly make in that trade. Okay, in an FB type of a trade. Right. So hopefully that makes sense. Dan, BA first and FB seems counterintuitive. FB exposes us to a continued drop risk. Yeah, that's why I don't do it first, because the BA gives me much more downside, and that's what I want to do first. Once we're in a move, then the FB to me would make a little bit more sense, because I'm not worried. If we're already in a move that's 5% down, I'm more willing to put on an FB trade then, because I don't know that I'm going down another 10% from there. Okay, I'm not, again, these are not black swan hedges. Okay, these are hedges that I'm looking to put on. FB is a 6% down move. But if you think at the beginning of a sell-off, I think we're ready for a 10%, 5 to 10% sell-off. I don't really want to be owning an FB trade at the very beginning of a 10% sell-off. I would be happy to own it after 5% down already. Because if we continue to go down another 3, 4, or 5%, that FB trade's really going to pay off. I hope that makes sense with what I'm doing. The BA at the beginning of a sell-off, to me, makes more sense because, hey, we may still go down 10, 20%, something like that. All right, American versus European options. I don't really have a preference one way or the other, to be honest with you, because I'm doing 120 days out. So not really matter, whether it's the end of the month, these AM trades or not. Uh, I don't really care. I'm not worried about assignment or not getting assigned uh, on those. So I'm really not, I kind of intermix them. Most of the time I avoid the AM and I will stick with the weeklies in here. But if I look at, let's see, do we have one that's close? Here you have one. I don't really have one here to give you a good example, but what's the difference here at 24 Delta? Okay, it's going to cost me $8 here for the AM expiration version. Okay. All right, so I don't really care. Neither one of them is going to expire on me. I would close it anyway. I wouldn't care. Okay, I mean, I can let it expire, but I'm going to close it if I need to. And if it's in the money, I'm going to close it ahead of time. So I would never really worry about it because there's almost no reason that I would never not close that trade. And the pricing is almost the same. Okay. Within a few cents, the pricing's about the same between the two. And there would be no reason for me to let the thing go to expiration and it be in the money and not close it. So my trade plan, for the most part, is going to have me closing for a winner, most likely on the PDS. So if it's in the money near expiration, I'm probably closing it anyway. So for me, I really don't care. It doesn't really make a difference to me because they're so far out that they don't really impact anything I do. I'm almost never going to have trades on that are going to expire tomorrow, okay, that are AM expiration type of trades. I really don't trade them anyway. But if it was in the money or close to in the money, I'd be closing it for a profit early before expiration date anyway. All right, so yeah, and you can just close them. So yeah, it really doesn't matter to me on it. But there's my take on that. So that's again, yeah, you can do a 113s, knock yourselves out. There's no rules here, guys. Do whatever fits your risk profile. For me, I can't do it. It's too much. The 113s give me way too much risk if I'm stacking them on. Okay, but you can fill out of. You can figure out how you're going to do them. That makes sense to your risk plan. All right. So anyway, there's the BA and the FB trades. Why I use them. I'm not doing them necessarily on oil or gold or copper or anything else right now. I am going to NASDAQ really sets up nice for 112 trades. I mean, these things set up so beautifully. In here, I really do like them. I don't do enough of them. Because I don't want to overexpose myself because I think if ES is going down, NASDAQ's going down. So I don't want to have too many of the same style trades on, but you get some pretty nice wide traps in NQ, and I think that's pretty nice. Setting these things up with a nice wide trap overall. Okay, you're still making good money here. $1,100, and I make $6,000 in the trap, which is better typically than my 112s on ES are. NASDAQ and I think NASDAQ's already heading down a little bit more, so that's why there's a BA112 here. As soon as my buying power frees up a bit, I will start to put on probably another BA trade. This BA here has only got 21 days left to live. I can take these naked puts off pretty soon, but this thing's almost dead. So hope that makes sense. All right, I know there's probably more questions in there for you guys. 1122s. I don't know how that would would you consider that with respect to hedging, like using a 1122 as a hedge itself, or just using a 112 so that I don't have to hedge? I think that's, I don't know. I have not been successful at 1122s personally, so it's just not something it's not something I set up well and that I'm very good at. I don't know how typically people set these up anyway. Okay. But if I'm looking at it, I'm not saying this is a perfect 1122 either. But from a buying power standpoint, buying power is not too shabby in here, and I'm making 10% but I'm only making 10% in 120 some odd days. So how do I get enough income out of this? Watch my own video. Yeah, that'd be good. If I'm doing a 112 trade, which again, I did a video, but it doesn't mean I trade it because I can't make it work. Okay. So on a 112 trade in here, I'm using, I'm not getting a giant amount of buying power relief, but I want to make sure I'm making the same amount of money here. And to me, it cuts my money down and really doesn't do me a whole lot having this down here. Adding the one, it's not too bad, but I don't worry about what goes on down here. If it's helping your buying power, but it's cutting down my income, which means I have to keep increasing the size. And when I increase the size, it's kind of negating the put. So again, not poo-pooing it. I know it can help. It's just for me and the way my account runs, it doesn't make me as much money to do that. One thing I'll bring up, and I know we're at the top of the hour, I want to show you something slightly different. Okay, and I'm going to talk about an IRA for a minute, and give me just a second. I'm going to switch the accounts. And because I didn't hide my accounts, I got to do that so you guys don't go and steal all my money. Okay, hang on just a second. All right, I think this makes sense. I want to make sure that I can do this. Perfect. Okay. Rock and roll. Get back into it for an IRA. All right. In an IRA, here's what's interesting in an IRA. So let's go and put on a 112 trade in an IRA. Something standard. This is probably pretty good. Okay. 112 trade. All right. So in an IRA, because of the way it's margined, you're going to take in approximately $1,200 using $10,000, almost 11,000. Let's call it 11,000, right? So my extrinsic here is 1,200. My buying power is 10,800. So let's just call it 11,000. All right. So I make 1,200 I make 10%. Okay, in 4 months. Pretty nice, right? So 10% in 4 months is a little over 2.5% a month. For an IRA, totally exceeds my goals. Life is really pretty nice. Okay. One thing that you can do in an IRA, okay, is really start to consider the 111 in an IRA, mainly because you can still generate pretty good. You can't stay at the 5 delta. We're going to have to pop it up a bit, but my buying power is significantly lower. So right now, I can make the same buying power. Okay, I don't even need to do that. Okay, so with a 111 trade, you can start to use these maybe in an IRA a little bit more. I'm still making 575 on 6,500 here. Still 8%, still a little over 2%. in the account, depending on how much you want to spend. But you can if you start to move these up a little bit, you can really see that I can generate, some pretty good, decent cash flow and have less risk in an IRA. So I'd consider potentially the use of 111s more in an IRA than I would in a 112. The only things that make me concerned on a 111 trade is when you start to move these deltas higher, you're now exposing yourself to a lot more risk in a bear market. Okay. Oh, well, 7% still pretty low, or 7 delta is low. 7 delta is decently low. It's not a whole lot different than 5, maybe. 8 or 9% though, that's a pretty substantial change. And now I'm not that far away. Okay, here I'm 400 points closer than I was, and I'm only, what is it, 700 divided by 5304. I'm only 13% away. It's not huge, but this is where I got into a little bit of trouble in a bear market, was when you move these naked puts up 8, 9%, something like that, and you start doing 111s, this is not that far away, and you're going to start to see 2x losses on these much quicker, okay, than you would see something down here that can weather it a little bit more without a major downtrend. Okay, major downtrend, either way, you're going to get beat up. Big vol shift, major downtrend. Small downtrend with just a mild pop, I'm not that far away. I can get into more trouble here. And that's the only thing I'm pointing out. I'm not poo-pooing it. People like the 111. I actually kind of like it in an IRA, taking a look at it, because it does reduce the risk exposure. And as we talked about earlier, the one thing that's important to note, and I'll wrap it up here with you today, the one thing that's important to note is the more naked puts you have, even farther out of the money, in a big sell-off with a big IV expansion, they're going to be in pain than quicker and worse than having one slightly higher would be. But that's also why, from a hedge standpoint, it's better if you're protecting something from a big vol spike, major sell-off. You can go down a little farther, put on more contracts. Some reason for the black swan hedge. You've got a lot of these way out of the money puts. They won't help you in a 5 to 10% pullback. They will help you, a big deal in a 20% downtrend with a, VIX tripling or quadrupling or something to that point. So you've got to understand, what is it that you're hedging? Are you trying to hedge both? It's hard to do both. Otherwise, you're just going to spend all your money. Okay, you're either preparing for a black swan type hedge, or you're preparing for something in the neighborhood of a 5 to 10% correction. Which one do you want to prepare for? Okay, if you try to prepare for both, you're going to spend all your money hedging. Okay? So you got to kind of pick which one you feel is the most valuable way to go for you. You have to make the decision. What's going to be most helpful for me? What's going to help me sleep at night? What's your risk tolerance? Where are you? So something to consider down there. Only from a safety standpoint, I'm looking at potentially a 111 from a safety standpoint versus like a 112 or something in an IRA. Their IRAs aren't really forgiving. You still make good money using futures. They're going to have a much higher margin requirement. So the less naked puts you have, potentially the better off you're going to be in a major sell-off. But as we just talked about, you can hedge it. And I'm not hedging for a black swan event in an IRA necessarily, but you certainly can do that, right? And then in a small account, I'm not doing any of these things. So there's no FBs, no BAs, no hedges for the most part in a small account, because I feel I can rebuild those fairly quickly. Okay. Might have to get a second job, might have to do something, okay, but I can refill a $5,000 IRA that loses $4,000. I can refill that quicker than I can refill a $500,000 account that loses $300,000. I can't just go stick 300 grand back into it. So anyway, that's my thing. Yeah. Speaking of Walmart, it's an interesting looking chart on Walmart. Anyway, not that this is stock talk at all here, but Walmart seems to be tipping over here a bit now, or at least a decent pullback. We'll see what happens there. Walmart's been on a really good tear, tipping over. They might need greeters, or maybe they won't be able to afford them if their stock breaks to 21 EMA here. So, all right. That's it for today. Difference between a BA and an FB. To me, the BA, longer trap, pays less, but it's much longer, much more forgiving on a 10% down move over time, over a couple months. I think it's great to start with the BA, okay? And then once you're maybe 5% into a move, then an FB might make more sense. Or if you don't think the initial piece is going to be a big move, and you want to just capture that first 4 or 5% and get out, it's just a matter of, does it keep going after 4 or 5%, or do you come down and it goes up a little bit and then it's going to, that lower low, lower high? Well, when it hits the lower low and starts to go back to a lower high, that's where potentially you want to, at the lower low, that might be the place to put the FB trade. And then if it moves back to the, the lower high and starts to make that next move down, then you've got it, you're in pretty good shape. So maybe a little charting would help you on this. All right, so I hope that makes sense. Enjoy a great Easter, everybody, if you celebrate. If not, enjoy a fantastic rest of your weekend. If you have any questions, you can pop them in chat. All right, we'll talk to you later. See ya.